Drawing support and resistance the right way is one of the most important skills in technical analysis. These levels help you identify high-probability trading zones, improve your entries and exits, and understand market behavior more clearly. In this video, we are going to talk about what support and resistance levels are, how to identify key zones, and the right way to draw levels using both wicks and bodies, how price behaves within these key zones. We'll explore how markets range between support and resistance, explain the concept of SBR and RBS, and guide you through practical trading setups, all with real chart examples to help you apply these concepts in live market conditions. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. A support level is a price zone where buying interest is strong enough to prevent the price from falling further. It's where the market tends to find support as it moves downward. When the price is rejected twice or more from the same zone while attempting to move lower, this indicates that buyers are stepping in at that level, making it a valid support zone. Once this support level is identified, we wait for the price to pull back to that zone. This pullback offers a potential buying opportunity, because there's a high probability that the price will once again bounce upward from the support, just like it did before. Support levels are not just random areas, they are zones where market psychology shifts. Traders remember these levels, and they often become high-probability zones for entries in the direction of the trend. A resistance is a price zone where selling pressure outweighs buying pressure, preventing the price from rising further. It's where the market tends to hit a ceiling during upward moves. When the price is rejected twice or more from the same area while attempting to move higher, it signals that sellers are actively defending that level, making it a valid resistance zone. Once this resistance is confirmed, we wait for the price to pull back and retest that level. This retest creates a potential selling opportunity, because there's a strong potential that the price will reverse downward after encountering resistance again. Resistance levels play a key role in price action trading. They help traders identify strategic points for entries and exits, especially when combined with confirmation signals or market structure. When both support and resistance zones are clearly established, and the price is moving back and forth between them, we say that the market is ranging or consolidating. In this phase, the price respects the boundaries of support and resistance, bouncing upward from support and reversing downward from resistance. The strength of a support or resistance level is determined by how many times the price has been rejected from that zone. The more rejections, the stronger and more reliable the level becomes. During a ranging market, traders often take advantage of this structure by buying near the support level, anticipating a bounce upward. Selling near the resistance level, expecting a move downward. This strategy remains valid until the price breaks out of the range, either above resistance or below support. A breakout typically signals the start of a new trend. Range trading is a powerful method, especially in sideways markets, but it requires patience, discipline, and clear confirmation signals. SBR occurs when a support level is broken, meaning price falls below a level where it previously found buying interest. Once broken, that same level often acts as resistance or support becomes resistance when the price pulls back to it. In simple terms, a zone where buyers once stepped in now becomes a zone where sellers are in control. This shift happens because traders who were previously buying now see that level as a potential sell zone. So, once the support is broken and retested from below, it becomes a potential setup for a sell trade. RBS is the opposite. It happens when a resistance level is broken, price moves above a level it previously struggled to break. After breaking above, that same level often acts as support or resistance becomes support when the price pulls back to it. In simple terms, a zone where sellers were once strong now turns into a level where buyers step in. This makes it a high-probability buying opportunity when the price comes back to retest that level. Now that we have a solid understanding of support and resistance, as well as SBR and RBS levels, Let's move forward and see how to draw support and resistance zones on real chart examples. Look for areas where price has bounced multiple times. These are your key support zones. You're not looking for an exact price, but a zone where buyers consistently stepped in. The most reliable support zones include both the lowest wick and body closes. Use the lowest wick among all rejections as the bottom boundary, and the body close or wick of the second bounce as the top boundary. This creates your support zone. As you can see in this example, the price is rejected twice from the same area, confirming a strong support zone. Now, when the price pulls back to this support, it forms a bullish harami candlestick pattern. This gives us a high probability entry point for a buy trade, because the market is likely to bounce upward. Don't worry about candlestick patterns at this stage, we'll cover them in detail in the upcoming videos of this playlist. Now to draw resistance, look for areas where price has reversed multiple times. Use the highest wick among all rejections as the top boundary, and the body close or wick of the second rejection as the bottom boundary. This range forms your resistance zone. If the zone is too wide, you can adjust it by using the wick of the second rejection to narrow it down. In this example, the price was rejected multiple times from the same zone, forming a solid resistance level. Once this resistance is clearly identified, we wait for the price to pull back to that zone. A bearish harami pattern formed upon retest. This becomes our entry point for a sell position. And as the chart shows, the price made a significant move downward from that resistance, offering a great opportunity. Here, we've identified a clear support zone as well as a resistance zone, using the same method we discussed in the previous example, by observing multiple rejections and price reactions at those zones. As you can see, the market is currently ranging between support and resistance, meaning price is moving sideways within this zone. At this point, we prepare for two possible scenarios. If price breaks below the support level, that support may turn into a SBR zone, support becomes resistance, and we'll look for a selling opportunity on the retest. If price breaks above the resistance, that resistance may turn into an RBS zone, resistance becomes support, and we'll look for a buying opportunity on the pullback. In this case, price breaks above the resistance level, and we do not see any bearish confirmation that would justify a sell. So we wait for the price to pull back and retest the broken resistance, now acting as RBS. On the pullback, a bullish confirmation candlestick pattern forms, a strong signal indicating that buyers are stepping back in and a continuation to the upside is likely. This becomes our entry point for a buy position. Stop loss should be placed just below the confirmation pattern. Take profit can be set at the next resistance level or based on risk-reward ratio. Remember, support and resistance are not just lines on a chart, they're reflections of market psychology. Master them, and you'll stop chasing the market, and start understanding it. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.